This episode is brought to you by SS&C Mineralware. Are you managing mineral assets and feeling overwhelmed? Unsure if you're getting paid what you're owed? SS&C Mineralware is here to simplify the management of your minerals, royalties, and non-operated working interests. Mineralware's out-of-the-box features give you the tools you need to visualize and keep track of all of your assets in one place. Mineralware lets you know in seconds where your interests are, what's active, what acreage is open for lease, and if you're getting paid what you're owed. With Mineralware, you can even automate your revenue and JIB processing and eliminate tedious manual data entry, allowing you to focus on more pressing issues. Thousands of mineral owners rely on Mineralware to keep their mineral management simple, automatic, and all in one place. Take control of your mineral assets today with SS&C Mineralware. To see a demo, you can visit their website at www.mineralware.com. That's mineralware.com.
Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to answer listener questions that were submitted last year at this point, 2025, but we're sitting at February of 2026. And thank you for all of you out there that have submitted questions that we haven't gotten to yet. This will bring us up through July of 25. So we have a lot of questions to go through. We try to go through these pretty systematically. So rest assured, we will get to your questions someday. And if you have an urgent issue, please feel free to email me. I just get so many emails, I can't respond to them all. So thanks for your patience. But Justin, I thought it was interesting as we were going through the show notes here and getting ready for this particular episode that there are a lot of questions in here, I think, that are, like everything, always very fact specific to someone's situation. And, we'll dive into that and tell you some of the principles to think about if you're faced with a similar situation. So, rest assured that if you are faced with something like this, even though you're not dealing with Mike or with Judy's issue or, some of these other listeners, that, you can apply these principles. And we'll give you links to the resources we mentioned here. There's a lot of past episodes we're going to mention. So definitely check out the show notes, which you can always find at mineralrightspodcast.com to find those links. So Justin, without further ado, do you want to dive into the first one?
All right. Our first one here is from Judy. Judy says, I inherited mineral and gas and oil royalties, and I need to protect some for income tax purposes. What's the best way? Matt, this is a really timely question since we're approaching tax season yet again here. And this seems to come up every year, but mineral owners have a few things available to them. And it depends kind of what their asset is, whether it's a working interest or a passive interest. But the most common is that depletion deduction, Matt, which is something that mineral owners certainly shouldn't leave on the table. That's 15% off of that revenue, which helps a lot.
Yeah, you're absolutely right. And that's an amazing deduction. It's the percent depletion deduction is that 15% number that Justin mentioned. There's also a cost depletion, which is, I would say, not applicable to probably 95% of royalty owners just because it requires you to get an appraisal of the interest and to understand the reserves. So you're basically in that situation taking the cost of that asset or the value of that asset and then depleting, over time based on the actual production as, relative to the overall potential, as far as the reserves. And so that gets really complicated and expensive to calculate unless you have a lot of interest. Probably not worth even thinking about, that 15% cost depletion deduction is just something you can take. Your CPA can help you calculate that if you're unsure. And there's other expenses or other deductions potentially depending on your specific situation. And as always, we recommend to check with your financial advisor, your CPA, your attorney, for specific advice to your situation. Don't take this as advice in any of those areas, but just as, information. And I will say, if you're just holding on to those and wanting to just receive those royalties, that's probably the best and kind of the only way, unfortunately, that I know of really protecting income for royalties in terms of not being a business. So that you mentioned it's not a business. So that would potentially limit some other deductions. If you have a business, there's other expenses oftentimes you can deduct from that. And if that's your business of managing royalties, that could be, there should be other expenses out there. But again, check with your CPA. There may be some other things out there, other expenses you incur that you could deduct. And then if you ever sell the interest, I will say there's a trade-off between ordinary income, which is how royalties are treated. And that is just whatever your tax rate is, that incremental tax rate, you get taxed at that for that royalty income. And if you're a high income earner, that can be a significant percentage relative to if you ever sell the interest. And I'm not advocating necessarily to sell to save on taxes, but if you do sell, you're taxed at a much lower rate. That's typically the long-term capital gains tax rate, which, for most people, I think it's around 15%. And so in that situation, it could be trade-off, right? Because you're usually not getting as much as you would get if you held onto the asset for the life of those wells in terms of income. But if it means that you could save a significant amount in income tax, then that capital gains tax option may be something to consider. And in that situation, you would want for inherited minerals, Judy, to claim a step up in basis. In other words, whatever the value of those assets were when you inherited them, that would be your basis in that property. And then if you sold it for, let's throw an arbitrary number out there. Let's say you inherited it was worth $100,000, and then you sold it for $120,000. Well, you would only owe taxes, capital gains taxes on the $20,000 difference between the proceeds from the sale and your basis. And again, that's just for illustrative purposes, obviously. But that just gives you a sense for how much you could potentially save in taxes if you do decide to sell them down the road and you're able to claim a step up in basis because there was significant value when you inherited them. Now, one last thing to say, and again, go to the show notes because we have about 5 episodes on this topic that goes into a lot more detail. But from a tax planning perspective for the next generation, it's important to think about how those minerals could play into taxes for your heirs, for example, from the standpoint of if you have an estate that's near the estate tax limit, and these minerals that you just inherited going to put you over that, then maybe it makes sense to gift, do some gifting and talk to your financial advisor and your CPA to look at strategies to minimize that potential future tax liability for your heirs. So all of that is worth thinking about if you own minerals and royalties. Depending on your situation, it can, may or may not be applicable, but it's definitely worth thinking about and planning for the long term as well when it comes to taxes. So. Justin, anything else you want to mention?
I think you covered most of it, Matt. This is something every year that comes up, and there's always a lot of questions surrounding it. And like we always say, you're really finding a good CPA that's competent in minerals is really an asset that you can lean on, and that'll help you a lot throughout working with these, both for selling and for if you're going to hold those minerals and receive royalties. All right, Matt. So our next one here is from Mike. That this is a situation I think a lot of mineral owners find themselves in. His question is really 2 parts. He says he's reviewing some mineral royalty interest in Colorado and noted missing production payments that extend back more than 8 years. He asks in Colorado, is there a statute of limitations related to mineral interest payments? And then goes on to ask what happens if the operator at the time of when these royalties were produced is not the current operator. And Matt, that's really common, especially in West Texas where I own minerals. Operators change hands quite often through mergers and different things. So to answer his first question, it's probably the easiest to answer, Matt. Colorado has a 6-year period. So the statute says that a 6-year statute of limitations to oil and gas royalties claims, which governs all actions to recover a liquidated debt or an unliquidated terminable amount of money due. So that's kind of the easy answer. With the operators, Matt, this gets to be such a tricky thing because it can depend on so many things about how that operator merged, how that operator, did they go through bankruptcy, what exactly happened?
Yeah, that's a great point. So that is something, if it's a significant amount of money, it'd be worth talking to an attorney to see if you have a case. In this case, that the 2-year period between the 8 years when you figured this out and then when you're going to go after those missing royalty payments, then it could be worth digging into those details that Justin alluded to. And specifically, there's a concept called fraudulent concealment. And this was based on research. And again, we're not attorneys, so don't take this as legal advice. Definitely get help from an attorney that's qualified in this area of the law and knows oil and gas as well. But this whole fraudulent concealment concept would be basically if the operator concealed a fact that should have been disclosed to you. They knew that they were concealing that fact, and then that you were ignorant of that fact, and then that would basically there's a couple different things that basically that they would act upon that concealment, not give you the money and say, we're going to just hold on to this, and you had some damages to that. So there's like all these, and that's just a high level thing. This is not like a legal podcast, but it looks like that if you have that type of situation where they fraudulently concealed information, that could extend that limitation period potentially. And you could get some of those additional dollars. But again, it just very much depends on the specifics, and you'd have to be able to prove that, which may be difficult, especially if that company doesn't exist anymore. Unfortunately, that's a really tricky situation because they probably don't have any of those records, and you wouldn't be able to get them via discovery or anything like that. So, I would say there's other exceptions, and like what Justin mentioned is it depends on the way that those operators transacted when they purchased your wells. If there was express agreement to assume the prior liabilities in terms of, past due royalties and things like that, you might be able to go after the existing operator. Also, if they merged, so if that was basically a different company name, but basically it's the same company because it was a result of a merger of two companies, and then, or if it's effectively the same company, but they just changed names, right? Those are the types of things potentially that could cause that current operator be liable for those past debts, so to speak. But again, that's really needing to find those assignment documents and legal paperwork regarding the merger, if there's division orders, or if you have lease terms potentially. This would be another area to talk with your attorney about, is if there are explicit language in the leases that royalty obligations run with the lease, that might potentially change that. And that could be something where you could go after the current operator. But again, these are parts of the law that are very complex and really just require a competent attorney to give you advice specific to your situation. But it does look like potentially you may be out of luck on the royalties that were extending back more than that statute of limitation period of 6 years in Colorado. In the meantime, also, I would say there are specific actions you can take to enforce your rights, at least, to claim what is owed to you within that 6-year period. So, going after that previous operator, assuming they're still in business, sending demand letters, via certified mail, having your attorney draft a letter. All of those things are good actions. And I think there are some specific things that we'll outline in a couple of episodes. So one of them is episode 224, which is what to do about late royalty payments. And then episode 103, which is how to find out if you have unclaimed royalties. And the last thing I'll mention is one thing to do is to check that those royalties weren't escheated to the state. So it's very possible that that previous operator actually handed those royalty payments over to the state of Colorado or whatever state you or your ancestor lived in to administer per state law, right? So they require, and the state will audit oil companies to make sure that they've handed over those payments in the time frame that's required by law. And so that is a good thing from a mineral and royalty owner perspective, because it means that if that company went out of business, you're not out of luck, that the money is sitting there in the state coffers and you just got to go claim it. There's a whole series of forms you have to fill out and documentation you have to provide to get that money, but it's still there. So that's a definite benefit for mineral and royalty owners. And many people will find that you actually have stuff out there, whether it's in your name or in a predecessor's name. So definitely worth doing, because that could be a situation that would get you off the hook, I guess, in terms of that statute of limitation issue, is if that previous operator had tried to pay those royalties to a predecessor or to you, and they just ended up escheating it to the state when those checks were never deposited. So that could be another option.
And that, that happens pretty often, Matt, especially with smaller amounts. The companies want to charge that off the balance sheet. And if a reasonable effort was made, again, on their side, it's a business decision. How much does it cost to find you versus how much do they owe you? So it can be a good way to kind of track back properties. And sometimes they have information about the property itself, like legal land descriptions. Sometimes they don't, but it's worth taking a look.
Yeah. And on that note, this next email relates directly to that. So Douglas wrote and he said, "Thank you, Matt. This sure works. I was able to apply for many claims totaling $375. Wow. Thank you." So what Douglas did is I have, so first of all, I have an email list that I have a free weekly email newsletter that I send out, as well as when you first sign up, I send you a series of emails with some helpful tips and some actions you can take to find missing royalty payments in this case. And I walk you step by step on how to find those. And then there's ways to go and then claim it through that website that I mentioned in that email. So if you aren't already a subscriber to my email list, it's free. You can unsubscribe anytime. There's no commitment, no payment, nothing like that. Just go to mineralrightspodcast.com and click on the Join Now button, or tap on the Join Now button at the top of the page to be taken to a form to drop your email address in there, and then get those free how-to emails and, give you some quick wins to get hopefully some free money out there that's waiting for you to find it. So that is, like we said with that previous question, looking for the missing money, both in your name and your ancestors' names, is something to do periodically, because, there's things that, reach that time period where they get escheated to the state, and then it, will pop up in that list and you can claim it. So yeah, definitely something to think about. And there's really no reason not to be on the email list. I send out only one email per week, besides that first series that I send you with those helpful tips. And I give you some additional information and additional resources and deeper analysis on each weekly episode. So if you want to get that, definitely sign up.
And Matt, along with that, the course is wonderful as well, especially if you're starting at zero. You just found something in unclaimed funds. You don't know where to start, how to begin. Matt, your course is wonderful. And we suggest it to people all the time, both at the National Association of Royalty Owners and me personally. So moving on, Matt, this next one here is similar to the one previously, but this is from Greg. Greg says, an oil company who hasn't made a payment since at least 2009 on 2 wells in Brazos County, Texas, at the property produced over 51,000 barrels since 1994. They finally decided to make good on past due payments and claim they owe about $1,000 for 2009 to present. Does this even sound realistic?
Yeah, that's a good question, Greg. I guess you really don't have enough information to say one way or the other if that is in the ballpark or not. It depends on your decimal interest on those 2 wells. And so in other words, what percentage of the minerals you own, what your lease royalty rate is, all of those things go into determining what your net revenue interest is in those wells, and that'll determine what you should be owed. Now, I will say there's some things you can do in terms of just checking to make sure that those values match what's on your revenue statement for that make good payment. And you mentioned 51,000 barrels, so it sounds like you probably have already gone to the Texas Railroad Commission website to look that information up, but that would be the first step, is to look up those 2 wells, find out how much they've produced during that time period when you were owed royalties but were not paid, and then determine also, and the best way to do this, the most accurate way to do this would be to list out by month and look up the historical spot price for West Texas Intermediate crude oil, which you can find at the EIA website. That's the Energy Information Administration website. They publish the average spot price by month. You can download that into a spreadsheet, copy that into your the other spreadsheet you downloaded from the Railroad Commission, and then calculate the gross payment for oil, and then just apply your decimal interest to that gross payment per month. And then you can add those up and determine, okay, does it add up to $1,038 or close to that? It's probably not going to be exact, because your actual amount that they were paid for the oil may vary from the spot price, but at least should get you in the ballpark. If you know that it should be $10,000 and you only got paid $1,000, well, that tells you that something's up and you need to dig a little bit deeper. So that's what I would recommend, Greg, as far as doing that to determine, is that payment in the ballpark? And that's assuming that, again, your decimal interest is correct and that hasn't changed over time since the underpayment. So that is the what I would do. At least, they haven't paid you since 2009. So again, download the data from 2009 to 2000 and whenever you got your 2025, assuming when you got that payment, and then figure out what the value was there, and then go from there. So hopefully that helps. Justin, any other thoughts there?
You covered it, Matt. I think that pretty much sums it up. It's pretty easy with the Texas Railroad Commission, thank goodness, compared to some other websites. So at least you can go in and find that information and create a list pretty quick. All right, our next one here is from Celeste. Celeste says, I'm a mineral dealing with held by production from old leases on shallow gas wells in Ohio. Some of the wells are no longer in production and others have some production. Not getting royalty checks. One of the leases was a pooled arrangement with other landowners around the property. Now I'm getting ready for deep well drilling. So Matt, at least that's good news. Sounds like they're going in and doing horizontal drilling on some old leases held by production. There's a few other mentions here which kind of allude but are a bit unclear. So what's your take on this, Matt?
Yeah, I can make some assumptions and give you my thoughts on those different possible scenarios, Celeste. I will say that if you have leases that are held by production, and you have some shallow wells that are maybe shut in this case, it sounds like, or, maybe you haven't gotten to that minimum payment threshold. You mentioned not getting royalty checks, but that some of them have production. That throws up a little bit of a red flag to me. So I would definitely check to see, back to these previous questions, are you owed some past due royalties? One thing I forgot to mention, those previous two questions on this topic, is you may be owed interest. And so you definitely want to assert your claim on that interest and make sure the operator pays you the interest for those late royalty payments. And again, there's very specific things in the statute, depending on the state, that will outline when interest is due or when it's not. But that, in general, make sure you think about that and you talk to your attorney about the interest payments. Yeah, I would say that would be the first thing, is just to check and look at how much has been produced. And then what's your specific decimal interest in that well? How much should you have gotten paid? If it's below the minimum payment thresholds, oftentimes when you sign a division order, you agree to $100 minimum payment. So it could be that they're just waiting for the royalty payments to accrue up to $100 before they cut a check. And so that could be a reason why you're not getting paid for that well or the wells that are producing still. I will say it does a very common situation, whether it's in Ohio or in another state, where you have a shallower vertical well that's holding an older lease, and the operator is just biding their time to come in and drill some deep horizontal wells. And then, because that is held by production, so they're not on the clock, necessarily to do anything until that well gets, close to being, stopping producing and getting plugged, because at that point they'll have to release those old leases. And oftentimes it's way more economic or beneficial for them to drill new wells before those old wells peter out, because they're oftentimes held by like a 1/8 royalty or very low royalty rate, which means that they'll get a lot more or a lot larger percentage of the revenue from those wells, versus if they had to lease them under today's market, they may have to lease it at 20 or 25% royalty, which would mean they would get a smaller piece of the pie. So if you're curious and you're getting ready for deep well drilling, I would just reach out to your operator and ask them what their plans are and when they're going to drill wells in your area, assuming that they're drilling in that immediate area and that it's just imminent. Oftentimes they will share that information. I've been surprised both in talking to operators on my interest and on behalf of clients, where they said, yeah, this is what our plans are for this whole unit and how many wells we're going to drill per year and how we're going to do it. And sometimes they won't, a lot of times they won't, but if they do, then you can have that information to know what to expect in the future. So good luck.
Always worth asking, Matt. Yeah, being friendly to the division order analyst can take you a long way into understanding, and then they're there to help you. I mean, their job is to work with the owners. Matt, our last one here, I thought was really interesting. It looks like it's a response to an email you sent out and a question you asked of listeners or members of your email list. Have you ever tried to forecast your royalty income? And this response here is from Mike and gets really technical into how he does it. But I think it's super interesting to go through because it's a bit mind-blowing to me as somebody who's non-technical. Everything you're going through, what you're looking at, the research you're doing, and then how many factors really play into trying to, forecast income or even come up with an evaluation.
Yeah, absolutely. And this is the reason I picked this one. I wanted to shout out Mike, is I thought this was awesome, the things that he's doing. And I think it's really cool to see people, coming up with this stuff. And it's essentially the process that I use when valuing assets or forecasting wells for clients. And so what Mike said in his email is, this is just a quick note to let you know I do try to forecast royalty income for a family trust of about 800 currently producing assets, mostly in North Dakota. These assets have entered production at various points in time over the past 20 years or so. Our interest in each asset is small, but somewhat substantial to us in total. Some represent older declining wells. Others are newer wells. The family inherited these assets about 3.5 years ago, and I've been developing spreadsheets to help project current and future income by attempting to project both revenue and pricing using data and information obtained online from the North Dakota Mineral Resources website for historical and actual production of our assets, and the EIA/the Economy Forecast Agency for future pricing projections. I've set my spreadsheet/workbook calculation so our data matches to the data from the North Dakota website using API numbers. And API number, just for if you're listening to that and don't know what that means, that's the American Petroleum Institute number. And that's basically a unique number that every well in the United States has that will identify based on that 10-digit number your well. So that is a way it's just a unique identifier and a system that is kind of universally used across the industry to identify wells. So he goes on to say, in pricing websites, which I copy and paste into separate monthly spreadsheets within my workbooks. So the next thing I thought was just really cool was he says, I developed decline curve estimates for our assets in total, decided not to go through expense, time, effort to attempt to calculate for 800 individual wells, which I don't blame you there. That would take a long time to do on a monthly basis or a yearly basis, depending on how frequently you're going through that process. But he's using historical production data since 2016 from the North Dakota website. So what he does is he says he compares total annual production for both points in time to develop a decline rate based on a rate calculation formula. To be a little more conservative, I then blend that with average decline rate for the Bakken, which I found online, to develop a decline rate to project future annual production for the total trust assets. Well, so all that, you may be thinking, I have no idea what they're talking about. All that is a best fit curve. If you remember from math class where or science class where you collected data and you had to put it on a graph and then try to fit a curve to it to model or to project the next data point or the next observation. And that's basically what we do with decline curve analysis. Basically, we take the historical production data, ideally on a well-by-well basis, and you forecast that production based on a set of rules that are pretty well known to match reservoir conditions. And so you can use that to come up with a particular formula to forecast future production. There's a very specialized software that I use to do this, and there's dozens of different ways, different companies that make software that take well data, production data in particular, and forecast future production. Now AI they're using to do this in an automated fashion, so you don't have to do it manually. But whatever the case, you basically apply a curve to that, and then you can use that curve and say, okay, 6 months in the future, what will the future production rate be on, let's say August of 2026? And so you can use that curve, and depending on how accurate it is, will determine, how accurate your forecast is. And obviously there's a lot of real world things you can't take into account. Like if you have a bomb cyclone and it shuts in production for, half the month because of freezing temperatures or something like that, those are things that you can't predict in your model, but, you can adjust and you can say, well, hopefully production will recover back to the curve. And then, or if not, you can adjust the curve going forward to make it fit the new production profile. All that to say, Mike, is, and he says here, and I thought this was really interesting, is he found the biggest variation in my projections for future revenue comes not from production projection, but for the variation in pricing from year over year, month to month, day to day. I've been only doing this for 2 to 3 years, so I don't have a lot of data to rely on, but generally find variation for my production projections less than 10%. Which seems acceptable to the family at this time. And he says, I'd be interested in your opinion of this methodology and or means to improve accuracy without having to incur cost or more work to do that. So, Mike, I would say just kudos to you for figuring this out on your own and coming up with this process, because ultimately it sounds like a robust process that, in your case, it's fit for purpose. It meets your needs, gives you a way to forecast future revenue from these assets. At a level that meets what you guys are looking for. So I would say I wouldn't change what you're doing if it's streamlined, if it's sufficient. The only thing I would suggest with 800 wells, there may be ways to use a mineral management software to automate some of this. It'll do it for you, so to speak. It'll do that behind the scenes. It'll model and forecast every well individually, and then sum those up, and then give you that aggregate number, because there probably is a little bit of flattening out of that curve or dampening out some of the variation that you do by averaging 800 wells together and looking at just that total production number. That said, it's, with most of those wells being relatively old, it sounds like, then in that case, that works, right? Because those wells aren't changing, their decline rate isn't significantly changing from month to month, way out in the curve there when they've been producing for 20 years. Now, if you had a bunch of brand new horizontal wells that were coming online, that method may not work so well, because those newer wells would maybe dominate the average for a period of time, and then sort of shift into that more steady state mode, and when that kind of methodology that you mentioned would work better. But for now, I'd say if it's working for you, if it's not broken, don't fix it, so to speak. But if there's a way to automate it, that'd be the only suggestion I would have, is if it makes financial sense for you to, load your assets into a mineral management software and have it do that for you. So that you just have to check and not have to do the downloading and uploading into your spreadsheet and then making sure that you didn't miscopy something. Because anytime you're copying and pasting stuff, there's a chance that you could put it in the wrong spot and then stuff gets skewed, or, you get the wrong conclusion based on the data that it's presented. But great work, I would say, for doing what you're doing. That's pretty amazing to hear how you've done this on your own. And again, decline curve analysis is the way that oil and gas professionals and reservoir engineers model wells, right? So that is spot on. And, if you found the average decline rate for the Bakken, and most of your wells are Bakken wells, that sounds like you've done some research and figured it out to make sure that the model makes sense relative to other observations. So great job.
It's a highly technical process, Matt, and there's a lot of work that goes into it. But like you said, there are a lot of mineral management softwares, and it continues to evolve. I'm interested to see kind of what comes next and what the market does. It's kind of looking like with some of the options that you can either go for really in-depth information or, some others are kind of making you the product. So do be careful there, but they are handy platforms, man.
Yeah, absolutely. And I will say that we have past sponsors of the show and current sponsors of the show have mineral management software options. So you should definitely check that out. In fact, this episode is sponsored by SS&C Mineralware, which is a great option for if you have larger interests. So in your case, depending on how much revenue you make, it might be worth reaching out and giving them a call to find out more if it might meet your needs to help save you some time. But it sounds like you're already on top of it. I wouldn't change what you're doing necessarily. But again, that'd be my only suggestion is if there's an automation opportunity there, save you some more time. But yeah, great job. So again, if you have any questions you'd like us to answer, send it to feedback@mineralrightspodcast.com. And as always, we'll link to the resources we mentioned in the show notes, which are at mineralrightspodcast.com. So thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.